Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking about the price of gold. And my guest is Russ, Mould, Investment Director at AJ Bell. That price rose to a record high earlier this month as traders bet the US Fed would start cutting rates next year. Lower interest rates would reduce the opportunity cost of holding a zero-yielding asset such as gold. But bets were off after last week's non-farm payrolls came in stronger than expected. And now markets are looking forward to rate decisions by the European Central Bank, the Bank of England and the Swiss National Bank, all on Thursday. So, how dependent is the price of this precious metal on central bank rates, or are there other factors at play? Let's ask Russ Mould. Russ, hi, thanks for joining us. As I said then, this run-up in the price of gold seems to be a bet on central bank rates coming down fairly soon, but what if they don't?
Yeah, I think it's a perfectly fair question. I mean, if you look at the 1970s, gold rocketed when interest rates were rocketing. So I'm not sure the relationship there is particularly strong, but it has been a part of traders thinking lower opportunity cost of owning as you said, a zero yielding asset. And so that has been a thought process, but a bigger thought process has been very much related to government debt and also how other central banks, perhaps not the Federal Reserve, have been busily buying the precious metal.
What about the size of the US fiscal deficit? Why does that make gold more attractive?
Yeah, it's a bit of a long answer, but the U.S. federal deficit was the third highest on record last year at $1.7 trillion when the economy was strong. So some people are asking the question, well, what happens if it ever does weaken and welfare payments go up and income tax comes down? Some people are talking about a $4 trillion deficit. Now, how easy will it be to get investors to buy $4 trillion worth of US treasuries with yields where they are and inflation where it is a difficult question to answer. Some are suggesting not very, and that as a result, the Federal Reserve, in a worst case, could go back to quantitative easing, start to conjure money out of the air so it can buy those treasuries back and keep a lid on the bonds yields. As I said, a long answer to a short question.
Central banks themselves have increased their buying of gold quite significantly, haven't they, after some years in which it wasn't fashionable for them to be buying it up? Why?
The biggest buyer has been China, but some other emerging markets have been involved as well. Russia, possibly for all sorts of different reasons. Again, that's perhaps some are taking a view that they've already got too many US treasuries with a mountain of the stuff potentially coming out down the road. Some degree of diversification of their own assets. And again, this perhaps nagging fear that maybe inflation isn't quite going away, or that indeed we will see further money creation down the road.
There isn't a particularly direct relationship, I know, between the price of gold and the stock price of the major miners, but are they nevertheless a sensible way to invest in this?
If you believe the gold price is going up, then that's definitely one place that you'd be looking to do your research. If you take Warren Buffett's view that gold is a useless relic, then you won't be interested at all. And if you are looking at gold miners, you still have some very, very deep research to do. Do you go for senior producers or junior explorers or those who have just got an exploration license? And where do those miners operate is another key factor. Do they operate in developed markets or in, say, emerging markets where there's always the risk that there's some resource nationalism or the local authorities look for a higher tax rate or a higher cut of the action? So there's also, or there could even be a military coup, as we've seen in one or two West African republics in the past 12 months. So, but yes, ultimately, if you do believe the gold price can go up, gold miners do offer leverage in that. The safer way in is the bigger miners. The more leveraged way in, the more exotic way is definitely through the juniors. Probably a basket of them all. It would be the most sensible, risk-managed way to go if you think that's the right way to go. Just because even then, there are idiosyncratic things that can go wrong at miners, whether it's even the weather, for example.
Russ, one thing that's clearly changed since the 1970s is that you could now also use crypto as a hedge here. How does that compare with gold?
Digital gold, I'm told by people who believe in it. I admit I'm probably a bit of a no coiner myself, just because I find it harder to understand crypto, and I do the process of an inert yellow brick and how you get it out of the ground. But I think one of the reasons why Bitcoin has been so strong this year, up 150, 160%, is the same reason that gold's put on a good run. Maybe, expectation of lower interest rates, but again, the concept of high deficits, possibly in a worst case, money creation down the road, investors, traders looking for a haven asset where supply of that asset grows much more slowly than supply of debt or supply of money. So I can see there is some logic behind it, yes, for all of the fact that there are risks associated with crypto as there are with gold, as we've seen with all sorts of scandals and problems in the last 12 months.
Briefly then, Russ, are you a gold bug or a gold bear?
I'm probably a little bit more buggy. I would say I just look back at the 1970s when we had stagflation, when we had galloping deficits, when you just think, I can see why, you can see why there is demand for a haven, put it that way. And even if you don't believe that inflation in terms of prices is going to be a problem, inflation as a monetary phenomenon in terms of money creation and further deficit creation, that does look like it's going to be an issue we're wrestling with for some time to come.
Russ Mould of AJ Bell, thank you so much for joining us. Well, that was your look at gold. I'm Elena Casas, and this is Reuters.